Hello everyone, today with MarketXLS we're going to talk about the Straddle option strategy. MarketXLS is one of the top Excel-based investment research solution for investors. In this video we'll be discussing what a Straddle is, how it works, and how it is calculated using MarketXLS. So without any further ado, let's start with the topic. A straddle is best implemented when you expect the underlying security to experience significant volatility in the near term, and it is more likely to rally upwards instead of plunging downwards. It is a modified, more bullish version of the common straddle. A straddle is an unlimited profit and a limited risk strategy. What we do in this strategy is that we go long on the at-the-money put option as well as on two at-the-money call option contracts of the same underlying security and expiration date. MarketXLS offers a template for this strategy. Here's an introduction page for the users to read, and here's an active template. The yellow cells have to be inputted by the user, so the stock ticker, expiry date, and the ATM strike price. Upcoming expiry dates are available for reference on the side, and for the purpose of this video, we'll be using Microsoft. Expiry date as 18 June, and the ATM strike price is $2.55. We've bought one ATM $2.55 put as well as two ATM $2.55 call option contracts of Microsoft. We've built the net debit strategy and paid $8.48 to enter into the trade, which is reflected in the net cash flow section. MarketXLS has many templates just like the Straddle one you see here, and it refreshes all the data when you click on Refresh All. A payoff schedule and a payoff diagram are available in the template too. They can be used to analyze the maximum gain, loss, and break-even. Maximum profit for the straddle is unlimited and is attained when the underlying stock price makes a strong move either upwards or downwards at expiration, with greater gains to be made with an upward move as shown by the green boxes. Maximum loss is limited to the net premium paid to enter into the trade, and it occurs when the underlying stock price on expiration date is trading at the strike price of the call and put options purchased. At this price, all the options expire worthless and the options trader loses the entire initial debit taken to enter the trade as shown by the red box. Coming to the break-even point now. There are two break-even points for the straddle position, an upper break-even and a lower break-even. An upper break-even point is equal to the strike price of the calls or puts plus the net premium paid divided by 2, while the lower break-even point is equal to the strike price of calls or puts minus the net premium paid. That is all for today. If you want to read more about this topic, please visit the MarketXLS website, which has hundreds of blogs and templates. If you want to get in contact with us, please book a demo and we'll be happy to help.